Hello, everyone. Today on the final bar, my guest is Chris Brecher from Brecher Trading. We're going to talk about this bounce that we saw today. Yesterday, all about distribution. Today, much more about accumulation, but utilities in the driver's seat. So not necessarily the all clear, everything is great signal you may have been looking for, but let's look at the charts themselves and look at the short term versus the long term. And I think in terms of the long-term trend, we've broken some key support. Now it's all about the follow through. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets themselves. We focus on the message that price and breadth and sentiment, all those indications of investor psychology, how we can take all of those and quantify the decision-making of all the investors out there. Are they nervous, excited, euphoric, desperate, panicked, confident? All of that arguably is reflected in the price of assets. Now, after yesterday's sell-off, it is totally reasonable to have a bounce higher. That's why there's this thing called a dead cat bounce, which is a gruesome way of describing a day like today a lot of times, right? A big sell-off yesterday, a puking out, everything's going down, and then you see things rally pretty quickly. And the question is the sustainability, right? Is this bounce today the beginning of a recovery, a V bottom back to all-time highs? Or is this just what's called a dead cat bounce, a brief bounce before things continue down on their previous path? Based on what we've seen in the long term, I would expect the latter rather than the former. But as always, you have to be prepared for all of it. So it's all about the price levels. And we'll talk about some of the key lines in the sand to pay attention to. And we have a great guest today, Chris Brecher. Excited to have him back on the show. Coming up, next week on Tuesday, the 18th, we have Joe Rabel from Rabel Stock Research. He's also a co-host or a guest host frequently on Your Daily Five. On Thursday, the 20th, we have Katie Stockton from Fairlead Strategies joining us back on the show as well. Also, two special events to highlight for you. The week of May 24th, that whole week, is a new series of events called Chart School. Chart School is one of the more popular parts of our website, educational, teaching you how to use technical analysis in the StockCharts platform. We're going to do a Chart School series on idea generation, 5 different contributors all sharing the scans that they use to create new ideas, where they put new money to work. Also, on May 27th, I'll be moderating the next episode of The Pitch. That is where we have 3 different contributors, 3 different guests, all pitching 5 stocks each, giving you their best pitch based on their charts. We will have Aaron Swenlin from Decision Point, Mary Ellen McGonigal from MEM Investment Edge, and then Danielle Shea from Simpler Trading joining us. Should be a lot of fun, and it's usually a really good dialogue talking about opportunities across the equity landscape. Let's continue on with our market recap. So overall, the S&P certainly in recovery mode, a bit of a give back in the last half hour or so, but overall, it was really a reaction, I would say, overall to yesterday. So, it is totally reasonable and probably expected. And as we talked about on yesterday's show, after a big sell-off like that, it is rare to not have a big up day. One of the charts I was looking at earlier, I'll show you this one. Now, I don't know if it actually finished off completely how I might have thought. Let's see. This is the advancers and decliners as a percentage of the total listings on the NYSE. If you look yesterday, we had about 85%, maybe a little below that, of the New York Stock Exchange listings down on the day, which is pretty low. If you look back, it's pretty rare we've gotten above 0.8 or 80%, not too often. And what's incredibly rare is that if you have a big up day the next day, at least over 80%. We were there earlier in the day, actually settled down to around 70%. But first thing, it looked like a very classic bounce day. When the S&P is hitting its 50-day moving average, I would be amazed if you didn't have some sort of bounce higher. And you can see that many, many times when you hit the key moving average like that, you'll see a nice bounce the day after. The question is what happens next, right? Do we continue to recover back on the way to previous highs, getting above 4,200, or do we break down and break through support? As always, right? Support holds until it doesn't, right? A support level is valid. 40.55 is a key level to be looking at. But when that breaks, when you violate to the downside, that's when you have to start looking at further downside objectives here. Let's look at a chart of the S&P 500. Then we'll get back to some of the other key metrics to follow. Here we're looking at the S&P with the 50-day moving average in blue. I have a trend line taking the October and March lows. I am not surprised at all that we've bounced off of the 50-day and also this trend line. I think that's sort of a confluence of support. And now we're right back up to around 41.20, which was the breakdown level there, that support level from April. We've broken that. We're now bouncing up. And the question is, do we have another leg lower? I think if we do, I think that's where you start to see a potential acceleration of distribution, right? You see people that are recognizing the market is breaking down. That means individual stocks are not holding support levels. It doesn't feel as much like a short-term buy on the dip scenario, but more like a raise cash and get defensive scenario. That's what can cause corrections to be a little bit longer than a 5% correction. If you look at where we're at right now looks a lot like late January of this year. Is about a 4.7, 4.8% correction in a little less than a week. We bounced right back and made new highs. Right now, we've done the left end of that. The problem is further, deeper, longer corrections also start in a very similar way. And if you look in September, October of last year, that's where we spent about 2 months sort of backing and filling within a congestion range. And that gave the opportunity for some leadership rotation. That gave opportunity for new buyers essentially to come in, or enough profit taking that people were able to come in and push the price to all-time highs. So that is more along the lines of what I would expect here, given the extended run that we've had. However, you have to be prepared for the market holding and bouncing higher. At this point, it is a short-term bounce that I think satisfies anyone. If you're bullish or bearish, today makes sense. The question is what happens through the remainder of this week into the beginning of next week. Do you get that follow through to the downside? And that's what I would certainly be looking for. Now, what else happened today in terms of the big picture? Key themes would be mid caps and small caps outperforming. So the small cap S&P 600 up 2.4% versus the S&P up 1.2%. It's an interesting anecdote. The volatility read, if you look at the fear gauge, the VIX was up in the upper 20s, now coming back down to around 23. Which is a nice move back lower. 10-year yields lower. So the rising yields that you saw yesterday, sort of that indication of inflation concerns, that sort of alleviated a little bit today. And I should obviously point out in the afternoon, you have the news about the mask restrictions lightening up a little bit, and certainly seems like an encouraging headline for people thinking about economic reopenings and all of that. So yields coming down today, the 10-year in terms of the TLT, the long bond ETF, up a little bit. The dollar essentially flat to down a little bit. Gold and silver, precious metals, both up. Although commodities as a whole were down, and oil prices were down. Energy, one of the worst S&P sectors, actually the only one of the 11 that was down today. That's continuing on yesterday, some weakness there. Cryptocurrencies continuing to distribute. And it's interesting, look at a day like today where you have a bounce higher in risk assets, but Bitcoin not a part of it. Bitcoin's a really interesting one. You really need to think of it as its own thing. But I would argue that when you're looking at we're looking at the value of Bitcoin, it is, I would argue, pure speculation, right? People are either speculating it's going to go a lot higher, or are panicked and are speculating that it's over. But there's not a lot of fundamental story there. I mean, you could argue things that it's becoming more widespread and everything, but based on the volatility that you're seeing and based on the movement that you're having, the upside in Bitcoin at this point, or cryptocurrencies, are based on more people wanting to own it and pushing the price higher, very simply. And what you're seeing over the last 2 trading days is that is not the case. There are basically anecdotally more sellers than buyers. There's not a lot of interesting in pushing the price higher at this point. Sectors, by the way, very quickly, on a big up day like today, you might expect technology at the top. Not the case. Maybe consumer discretionary. Also not the case here was utilities. Boring, defensive, not offense utilities. So that is a bit of an asterisk on a day like today. Big update, but Utes leading the way higher should not be an encouraging long-term bullish indication. You'd want more offense at the top. So after utilities, there's industrials, financials, and materials. If you look at the top 10 scooter ranked stocks, it's a lot of stocks in those sectors. Now, energy is actually pretty well represented as well, with Marathon Oil and Devon Energy and others, but a lot of these, Freeport McMoran, Nucor, both in the materials sector, up at the top. and also have actually a bunch of consumer discretionary in the top 10 as well, with things like Nordstrom and Kohl's in the top 10 list. So overall, technology, which a lot of people are thinking of as a key area of focus, I think the relative weakness in technology has been a bit of a challenge if you're thinking long-term, uptrend. Now, granted, the market can rally without technology being in the driver's seat. That's absolutely right. But my question would be is if the FANG Plus index looks like it does, which to me, again, it's not broken support yet. The support on the FANG Plus index is here at the March lows, just around 6,000, a little above there. The 200-day moving average is right at 60.30 right now. So it's more like in the 60, 50, 6,100 range. But overall, that's where we hit bottom there. That also lines up with support from the end of last year. If that level holds, this is a stabilizing index, and it tells you that the downside is relatively limited. We're oversold right now, so it would not be unreasonable to expect to bounce like you saw there in early March. But if that level breaks, and if the FANG Plus index breaks its 200-day moving average, my question would be how much upside could stocks as a whole, could the S&P have, given that sort of breakdown? That would be the question I would be struggling with as a bull if you see any further downside on a chart like this. We need to take a quick break. We'll be back with my guest, Chris Brecher. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we focus on the action in the markets and how the short-term movements of today fit into the long-term picture. Whether or not you are a short-term investor, short-term trader, or a long-term investor looking months to years down the road, you need to understand both of those timeframes, I would argue, because regardless of where you're actually trying to operate, where you're trying to win the game, you are subject to the forces at play in some of those other timeframes. So it's really good to consider different timeframes in your work. Having said that, we are here to help you along the way. We'll do another mailbag segment on Friday's show at the end of the week. We would love to answer one of your questions on the air. Anything is fair game, technical indicators, particular tickers or charts, whatever is coming up in your own process. Shoot us an email, thefinalbar@stockcharts.com, with any of your questions. We're also on Twitter at FinalBarSCTV. On our YouTube channel, just put a comment below the video that you're watching. We'll hope to answer one of your questions on Friday's show. Also, as a reminder, go to StockChartsTV.com, use your email address, set up a free account. You can start watching all of our content on demand. We are also on all the app stores. Just search for StockCharts TV on demand. It's great to bring you all of our fantastic award-winning content, including great guests and great hosts, and also fantastic guests like Chris Brecher, who we'll welcome on here in the show here in a moment. Chris Brecher is the founder of Brecher Trading. He's been on the show before, always brings some charts that make me think, especially thinking about how the short-term environment relates to some of the long-term trends. Chris, welcome back.
Hey, thanks for having me on. It's been a little crazy market this week, but it's great that the charts I showed you worked. It's always scary if they
always
don't,
a win, right? Yeah, because you said these earlier, and there's so much movement in the market. So well done on that. Start us with an hourly chart of the S&P. What are you seeing right now?
Yeah, well, the first stop was that oversold. You see that big old arrow that you first got oversold at the support up there at 41.40, but it's always on how it works off the oversold, and it worked it off poorly. And then you have the path of least resistance. And that was sort of my theme, that I call it an air hole, but it's basically like if water leaks in your house, it goes to the basement, the path of least resistance. So you see that it went down to that blue line. But I'm not sure that's it, because that's intermediate support. I'm not sure that's major support. I think on a weekly, it's more like 4,000. But at least it stopped today. And what's really cool is this is prior to the opening, is the market rallied today exactly to the blue line on the upside and then sold off. So that was pretty cool. So
perfect symmetry, right? And
like
that was support a number of times in the last couple of weeks, and so far appears to be serving as resistance as well.
Exactly. So like we talked about, the more times you can connect the line, the more important. So all those bottoms were great support, and now they're resistance.
Chart number two, Chris, is looking at a key benchmark name, Apple, and I think the weakness in Apple, especially the relative weakness in Apple, has had a lot of people, thinking about how to treat this space and the other FANG stocks. Walk us through this chart.
Yeah, it's well, the one thing I have to tell you, this is one of the few times I've ever seen the stock sell off after earnings when they resume their buybacks. So
Mm,
it's pretty dangerous, but as you see in there, it had the sell off to 127 in early May, right to the blue line. Then it rallied up right to the resistance. I mean, it's a resistance zone, but I think the wider followed stocks, these things sort of work. And then it came down to the 127 and blew through that and went right to the major support around 122. And then today it rallied back to the blue line. Sort of cool that, I mean, I totally like using the 50-day like you are on the SPX. But when I'm trading shorter term or when these stocks are nuts, so I like using price support and resistance because I you sort of get in fast market mode, which is a term from the floor when I was on it of when it goes crazy. And so it's just easier for me to follow support and resistance.
And there's no arguing, I would say that, keying in on key levels, especially during some, periods of disconnection like we're seeing now, when volatility increases, focusing on some key lines in the sand makes a ton of sense. So can you answer this, Chris? So given what we've seen, right, yesterday with a lot of distribution in both of the charts you're sharing, and then today just sort of a nice rebound, how do you put that into context? Does a day like today make sense as a move higher before another leg lower, or is there some indication you would look for on some of these charts that would tell you this isn't just a bounce, that was the bottom and things are all clear? Like, what would tell you that that things are getting better from this point?
I think it's the bond market, the long-term bond. So when yesterday it reacted poorly to the hot PPI, I think that just spooked a lot of people saying, "Oh, we're in an inflationary environment and all that," even though the bond, yeah, the TNX, same difference.
Yeah.
And the thing is, though, is today it gave back a lot of it. So the bonds rallied a lot. So I think it comes down to now, are the bonds going to reclaim everything from the bad report, or are they going to go to new lows? So is that
Yeah.
TNX going to break up like you see, or is it going to go back and test like the May lows? And I think that's going to be the huge tell for the long-term direction.
So that's a great take, and we've talked about the interest rates and just this general trend and what that means for a lot of things, particularly growth versus value. Right? I mean, the sell off in bonds and rising rates have certainly been a huge headwind for stocks like Apple and others. We only have about 30 seconds left, Chris, but I'm curious if you had new money to put to work today. Where are you seeing opportunities, or where would you be looking as a place to either ride out this period or to capitalize on good opportunities?
Biotechs. Usually they do great in an inflationary environment or they outperform. So the XBI has gotten trashed, or the IBB, and you see it's right at major support. So
Yeah.
if I was going to have a place to hide, it would probably be some of the biotech stocks that also might be rumored takeovers like CRSP and Regeneron.
That's a great take, Chris. As always, listen, I really appreciate you coming, bringing some charts with you, and talking through sort of how you're approaching a period that is, I know, challenging for many. Chris Brecher, thanks so much for coming on. Stay safe, be well. We'll talk to you again soon, all right?
You too. Thanks for having me on.
That's Chris Brecher from Brecher Trading, and what I love about it, if you caught some of the comments he was making about the hourly charts, the 240-minute charts, and as I mentioned, I love having people on that are looking at different timeframes. That is a time frame I rarely look at. I don't bring a lot of hourly charts up on the show because I'm thinking more longer term. But if you look at some of those key price levels, it makes a ton of sense when the market turns. If you're long term and you're looking at the chart, sometimes some of the movements in the shorter term can seem a little less obvious, but when you're looking at the hourly chart, you can see where the investors, traders are keying in on particular price levels. And I love that comment, especially in periods of volatility when things start to get choppy. It is really important to look to the left, right? Start on the final bar, right? Start on the current price bar and look to the left and see where we're at relative to key inflection points previously. More often than not, that can tell you a lot about where you might identify opportunities. That's a great take from Chris Brecher. Let's continue on. Our next segment is called Getting Sentimental. Wednesday into Thursday, we usually get updates on a lot of the sentiment indicators. And I think it's helpful. Again, for me, this is one of the things in the toolkit. I start with price, I then look at breadth, and then I look at sentiment. And I think of all three of those as sort of the three key levers you can pull when you're trying to understand the macro environment. And there are other things, of course, like intermarket analysis and others. I kind of bucket those all with price. The main thing you can do is look at the price of assets, but then you have these other tools that can help you qualify what you're seeing. And breadth is an important one, telling you about participation. What, if the market is doing one thing, what are the stocks that comprise those markets, those indexes? What are they doing? And then sentiment, which tells you how people are voting with their words, what they tell you they're thinking, but also with their feet. And so this is a general umbrella for, for me, volatility data. It's also positioning data like put call ratios, and then also survey data like the name exposure index, like the AAII survey, where people are actually answering, are you bullish or bearish on stocks over a particular period of time? So having said that, we're using a chart list called sentiment indicators. By the way, as you probably know, this chart list and most of the things that I show on my show are from a group of charts and chart lists called the Morning Coffee Routine. To get to that, by the way, go to your dashboard. If you're a StockCharts member, go to where it says chart lists. At the bottom of your list, and I have a bunch of these, but if you go to the bottom, you'll see a little gray button that says Manage Chart Packs. Mine is called something like David Keller's Morning Coffee Routine, and this chart list that we're going to use, sentiment, is among many that are part of this chart pack that you can download as part of your membership. So we'll start with the VIX, and overall, a number of my guests in recent weeks have been talking about volatility, and we're certainly seeing all signs pointing to a higher volatility environment. If you think of 2019 and the VIX being in sort of the 10 to 20 range, 2020, after you had the big spike up in the March market correction, we sort of settled into the 20 to 40 range. And then about a month and a half ago, about two months ago, we broke down below 20 for the first time since February of 2020, which is sort of a lower volatility indication. And for about a month, we've spent our time back there. But then this week, you can see we've spiked back up and gone more toward a volatile environment. That's certainly what the market has felt like. If you look at this last week or so, it is certainly more of a choppy, more of a dynamic, volatile movement with some violent swings up and down. And it represents indecision in a lot of ways. This is called the fear gauge because a lot of people use it as a gauge for volatility, for uncertainty. Uncertainty in general does not tend to be a good thing for stocks. It's more something that you would see in corrective patterns. So an increase in the VIX certainly would line up with a downtrend in stock prices. I wouldn't be surprised if we see volatility levels more elevated than what we've seen in the last 4 to 6 weeks. Chart number 2 is looking at the sentiment indicator of the AAII surveys, the American Association of Individual Investors. These are a group of individual investors that answer a weekly survey. Are you bullish, bearish, or neutral on stocks for the next 6 months? And they're able to update their vote once a week. Comes out Thursdays. And what you can see is for the last really 4, 5, 6 weeks, this number has been trending downwards if you're looking at the bullish level. So right now we have about 36.5% bulls. About 5 weeks ago, this was almost to 60%. It was above 50%. Above 50% is what I call euphoric. That's sort of the really extreme bullish sentiment. The challenge there, or the issue, is that usually happens during one last big push higher. You see these huge spikes in bullish sentiment when we get up to the end of a move, sort of a late stage bull market environment. So when you've had a big long run and then you have one of those spikes, that can happen. Now, it can also happen, for the record, earlier, right? So when you broke out of the November sort of September, October consolidation, you broke out, you also had a spike in bullish sentiment. In November of 2016, when you had consolidated for about 3 months and then broke out, yet another spike in bullishness. So the difference there is those happened after a consolidation period. The spike we've seen now looks a lot more like what you saw in late 2017, early 2018, which was an acceleration of bullishness toward the end of the move after the market had already had a run for a while. That for me is concerning. Now, if you look back here, it was about 4 to 6 weeks before you had a big sell-off when we had that spike in bullishness. So right now, it's almost following this 2018, January 2018 playbook in terms of a big down week, a couple of weeks after a big spike higher in bullishness. I'm not saying we're necessarily going to have a week next week like we did there at the end of January, early February of 2018, but it's certainly interesting to see how it's lining up relative to that point. Bearishness, by the way, has been increasing, not in a huge way, but sort of over time, which basically tells you people are going from bullish to neutral, not completely going to the other side of things. The name exposure index is actually a really interesting one to look at. If you look, 2 weeks ago, we were 103%, I think, on the name exposure index, which basically means money managers, this is active money managers, are able to say 102%, 200% long, 100 or 200% short, or 0% basically naked equities. And they were 103%, which is net leveraged long based on all the respondents. Last week, it was down to around 84%, which is about a 20% drop in that reading. Now we're down another about 40% lower. It's down to below 50% bulls. And if you look back, that's actually below where we were in September of 2020. It's actually right about where we were in March. This is after the pullback in February to March. So again, what's interesting is we're at the point where we've been in previous pullbacks. What happens when the market goes a lot lower is this indicator goes a lot below 50%. So you can see the blue line represents the current level. Here in November of 18, much lower. March of 20, much lower. Even in mid 2015. So that going lower in the next week or two would certainly make this market feel a lot more like those deeper corrections and a lot less like the shallower corrections we've gotten used to in the last 6 to 8 months. That's our quick look at sentiment. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the New York FANG Plus Index. We looked at this chart a little earlier during our market recap. And again, I love lines in the sand that seem really straightforward. The New York FANG Plus Index, I would argue, is right at a very key important support level. This looks at price support from the March lows. This is where the index has bounced a number of times. Also lines up with the bounce that we had just before year end. I think breaking that level, breaking below 6,000, which would also take it below the 200-day moving average for the first time in probably a year and a half, that would be a significant topping pattern. Now, what's interesting is we've seen that topping pattern on a lot of other charts like Peloton and others that have already broken down. But the FANG index, this includes some of the bigger names like Apple and others, which at this point appear to be bouncing. And we're coming off an oversold condition or are currently oversold. So it'd be reasonable to expect a bit of a bounce. But I think breaking that level and you start to feel this market take on much more of a risk off feeling very, very quickly. Chart number 2 is where we ended our sentiment segment talking about the name exposure index. I think the incredible decline in the name exposure index basically confirms we are kind of at the point where we've been at the end of previous pullbacks. If we get any lower than this, you have to start thinking of this current move relative to some of these deeper pullbacks in price and or time. In 2015, we came off quite a bit, but it was really more of a time correction for about 6 months. We chopped around for quite a bit. Some of these other were steeper price corrections like at the end of 2018. So I think monitoring that in the coming weeks could be a really important tell. Finally, worth noting that there are plenty of stocks still reporting earnings. Obviously, so a lot of earnings in previous weeks, but today we have Disney reporting right after the close. This is a stock that really has been driven by Disney Plus subscribers. Other streaming services that have been growing subscribers have been getting hit just like Disney in recent weeks. Over the last month or so. With Disney, you're looking at a company that's faced with reopening theme parks, sort of the core of their business, potentially being able to open back up theaters as well. So the question is, what does this chart do from here? Distribution on a chart like this, it starts to make me very, very concerned. I think looking to hold 160 on any pullback would be a key support level on the chart of Disney. Folks, that's our show for today. Thank you so much for joining us every weekday after the close for the Final Bar. Get your questions in for us, thefinalbar@stockcharts.com for our mailbag segment tomorrow. Special thank you to Chris Brecher from Brecher Trading joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.